What's up, everybody? This is Will Jones, your host of the Free and Clear Real Estate Podcast. Today I'm here with Jason Benton with Foxtrot Mortgage Group, powered by Nexa Linden, and applywithmrbenton.com. Thank you for coming today, my brother.
My brother, I appreciate you. Thank you for having me.
Absolutely. So today we're going to be talking about how self-employed borrowers can get approved. The Linden playbook on how we can get those type of borrowers approved. Um, All right, so Jason, give us a little bit of background about who you are, how you got into business, what it is you do, and we'll get into the episode.
Yeah, so Jason Benton, by the way, born and raised in New Haven, Connecticut. I got into business in 2005. So I moved down here in 2005. I got into business about 2 months later. I was working in Coconut Grove for a small brokerage at the time. Didn't know much about mortgage or anything. Learned a lot from there. And then from there to now, I've been in banking, I've been in mortgages, and I've done finance also.
Okay. So self-employed borrowers, this is I'm gonna say a touchy topic, but a lot of people don't know a lot about it.
Uh-huh.
There's lots of misconceptions out there. Kind of tell us your experience. Self-employed borrowers, are they good borrowers? Are they bad? Like, what's the scenario behind self-employed borrowers?
So I think with self-employed borrowers is most of them don't have the conversation that they want to buy a home or that they're going to buy a home with their realtor, with their loan officer, or with their CPA or accountant, whoever they use. And the way they structure their business, their taxes, and everything, it's out of whack. So when the bank looks at it, they're looking at a totally different lens now than they did prior the market crash.
Okay.
Because prior to market crash, it was you made $1 million, you can write everything off. We're going to take what you say you made. Now it's like we're going to take what you say you actually getting taxed on,
Okay.
and that's been the huge difference. So these huge write-offs and these showing lower income and not proving that you're actually making money is putting them more at risk and keeping them out of actually qualifying for a home.
So basically, and are you're self-employed, considered self-employed?
Correct. Yep.
Okay, so you're considered self-employed, I'm self-employed. So obviously the goal at the end of the year is to write off as many expenses as possible. That's the whole lure of owning your own business, is
Correct.
that you're not taxed on what you make, but you can write off all your personal and business expenses. Not personal, but business expenses and stuff like that related to the
Correct.
business.
Correct.
So typically those borrowers, when it's come time to file your taxes, make no money on paper. And then they say, "Oh, but I made $1 million last year, and I want to buy $1 million house." And it's like, but your tax return says you made 10,000.
Exactly.
Oh, but I wrote everything off. So I don't think they are aware that you can't have both. You either going to pay the government or you're going to pay for your house and your down payment and your tax liability. Do you see that a lot? Is that a safe way to sum it up? Is that
It
you're going to
is.
have to pay one or the other. You can't get away with not paying both.
There's strategies to lighten the hit from the taxes that you get with your CPA, your accountant, but it's all about how you structure your business and how you structure the deals. A lot of people don't understand. I'm saving this in taxes, but if I'm able to pay taxes and I'm able to buy more investment properties, I can probably increase my actual cash flow so I can pay off the taxes or the taxes doesn't hurt me as much.
So you're saying most people look at the short term. I don't want to pay taxes versus saying, okay, if I pay these taxes, what will this lead me to down the
Exactly.
line?
Exactly. So it's risk and reward sometime, and I don't think we everything is just black and white for most borrowers, right? They don't see the other side of it. And it's like, okay, how can I minimize the risk for the bank? What makes it look better for the bank, the light in my risk? So now I can be a more qualified borrower. So that's why that conversation is so important to have with the realtor, the
Okay.
loan officer, and especially your tax professional.
Okay. You said something that kind of piqued my interest. How your business is set up. Is that something that they look at, like how your business is taxed, whether it's a S corp or just a regular LLC? Is the structure of your business, does that play into you getting qualified for a loan?
Not necessarily the structure, but when you setting it up and how much you own of the business. So we get a lot of borrowers who say, "Hey, I pay myself W-2." Cool. What's the percentage of ownership you have in the company? And they'll come like, "Oh, I own 50% or 100%." Well, I go,
Mhm.
"Hey, When you own more than 25%, you're now considered an actual person of influence in the business.
Mhm.
You're a decision maker. So now we don't just need your W-2, we need all your tax filings for personal and business now also.
So it's a little more in depth depending on how it's structured.
Its structure is correct, and how you're named on the business.
So the mortgage industry seems to have an issue, not maybe not an issue, but more stringent guidelines around self-employed borrowers.
Mhm.
Is that an industry issue? Is it a policy issue with the government? Is it just borrowers not knowing the situation? Like, what do you think is I guess the cloud over self-employed borrowers that because I know a lot of friends that have businesses and whenever we talk about buying houses, it just seems like I'm speaking German to them and it's so foreign that they can't wrap their heads around like being a self-employed borrower actually buying a house.
Yeah.
So what do you think is the reason for that?
Well, we'll say government policy. I'll say more secondary market. Of how is this loan sellable? Can I sell this loan on the secondary market? Right.
Mhm.
That's one thing. The second thing is I think it's not as hard as people make it out to be. It's planning. Right. Most small business owners, they don't plan to purchase. They're worrying about the now. Okay, I need to make this money and pay the least amount of taxes as possible. Then they're 2-3 years in with declining income, and they're saying I want to buy a home. So they come to us and we ask for their tax returns and their personal returns and their K-1s and everything. And we're sitting there like, but you're not making any money. So that's where I think the headache starts to like compound. And it's like, okay, let's take it one step at a time. We take it one step at a time, it makes it easier for everybody to figure out how we can get this done. And like I said in the beginning, it's not as hard as people make it out to be, but it
Okay.
can be difficult depending on how you're structuring your business, how your distributions and how you're paying yourself and your employees, and if you're actually making money. And that's the problem we're seeing most of the time.
So you said something, and I'm sure people that are watching this may not be familiar with this if your business isn't structured the right way. You mentioned a K1.
Yes.
What is a K1? Why would you have a K1 versus somebody like you own a business, you get a K1. I own a business, I don't get a K1. But we both have LLCs. Why are you have a K1 and I don't? Because some people don't even know how to go about getting a K1 or if they should have a K1.
Correct. So that's going to be distributions that you take from your company. When you take them, how much you take them. So that's going to reflect on, okay, I'm saying I'm taking these distributions to increase my income, but did my company actually make this amount of money for me to take those distributions?
Right.
And then where are those distributions coming from? And a lot of times we get caught up because they're start moving all this money around and not understanding the underwriter and the lender want to see the full picture. So if I see the full picture, I can understand like that's not earned income. That money came from a loan. That money came from a lawsuit. That money came from something else. It's not something you actually earn, and that's where the problems start to happen.
And even how you set up the LLC. So
Correct.
when you set it up as an S corp, that's when you get the K1
Yes.
distribution versus
Yes.
just open up a traditional LLC where the money that you make gets taxed through your personal tax return versus a business tax return.
Because you'll go on the LLC and it'll be like a personal. You're the only owner of the company, and it'll be taxed like that.
Correct. So if you own an LLC, definitely talk to your tax accountant, your CPA, whatever, to make sure your business is set up the right way so you can take advantage of all of the lending options
Correct.
that are available to you.
Correct.
Okay. What's a core lie that people believe about self-employed borrowers and how difficult it is to get a mortgage?
One, that you can write off everything. So you can say, hey, I made $1 million. I write off. Okay, I could just say I made 10,000 for tax purposes. But when I go to the lender, they're just going to add everything back on. It's like, no, it doesn't work like that.
Yeah.
It doesn't work like that.
Okay. Now, do you have that conversation in the beginning stages when you do your consultation up front, or is that something that you kind of hit them with throughout the middle of the process because they didn't disclose it or something like that?
No, I try not to hit nobody with stuff in the middle of the process. We do it up front or as soon as we do the pre-qualification, once we see their income documentation and their business structure and setup and everything. That's the best way to do it because if a lot of times people don't address certain things.
Mhm.
And then once it gets to a certain stage of the process and it's like, okay, we're 2 weeks out, but you're asking me for all these documents. I had no idea. And that's where the issues start to come. So you have the conversation sooner, you can address more things and then they'll understand instead of coming last minute. Even if they don't like it, the sooner you communicate, the better it is, especially for self-employed borrowers.
Okay. So kind of explain what a self-employed borrower would go through from consultation to closing. Like, what should they expect? What type of documentation? For somebody out there that's listening that says, I'm a self-employed borrower and I'm ready to buy a house, like what does that process look for that type of client?
So when we're first starting to have conversation with self-employed borrowers, we want to make sure you're truly self-employed. So once we know you're truly self-employed, meaning that you're not a W-2 borrower and you own 1% of the company, or you're just somebody out there saying they're self-employed because they have other businesses, but they're truly W-2
Right.
that aren't making any money.
I'm a self-employed because I have a couple side hustles.
Yeah, you have
I have a
LLC.
9 to 5.
Exactly. So once we get to that point, it's like, okay, we sit down, we say, okay, we need your personal returns, we need your business returns, we need your K1s if they're applicable, we need your year to date, and sometimes we ask for your balance sheet. The reason we ask for the last 2 years of all those things is because we want to make sure that income is consistent, that income is sustainable. Because a lot of times they'll have a huge year and then they'll have a bad year, but we want to know why they had that huge year, why they had that bad year. And then once we can structure that and paint the picture, it's better. We can move forward a lot quicker.
Are there mitigating factors for having a good year and a bad year that will still allow them to get qualified?
Definitely. There's things that happen where market shifts. Let's just say they had, and sometimes, to be honest, they'll actually underwriters say, "Give me your last 3 years.
Mm-hmm.
Let's see let's see how this story is really painted on this business." So, for instance, say we had COVID.
Mm-hmm.
You had 2 years. You had good business. COVID came. It set you back. Now we can explain, okay, these 2 years is income, these 4 or 5 months, 6 months, a year was declining, but now my year to date is back to where it was the previous 2 years. Now that picture being painted to the underwriter shows, okay, the risk is low because they actually make the money and there was an actual circumstance that happened out of their control that caused them to have that dip in income.
Okay. So the underwriters are able to look at situations individually and say, okay, this is a self-employed borrower, this is XYZ happened, this is what they qualify for. Versus, when you're getting a conventional loan, kind of most of those people fall into a similar category or a similar box. And, the underwriting may not be too
Flexible.
all over the place
Yeah.
or too flexible.
Yep.
Whereas on self-employed borrowers, because there's so many uncontrollable variables that they may have to look at, one person may not get what this person gets and that may not get what this person gets.
Correct. Because W-2s, it's easier to just put everybody in like a box because it's like, okay, this is how much you get paid. It ain't going to change unless you do overtime or something else. It's black and white. With self-employed, it's more, like you said, it's more moving parts. It's more circumstances that can happen where they can actually have a declining year in income. And we just have to make sure that it's not a glitch in the matrix where, oh, this was hot because of even COVID was good and bad for some people. So it could have been that year they spiked up in business, but their other 2.5, 3 years weren't as high. So that's a glitch that'll say, okay, this is really not sustainable.
So they're going to look at the majority, not that glitch from the COVID year. They're going to look at what's the majority.
The complete picture of the business over the past 2-3 years.
Okay. Now, if an owner of a business has the LLC, they pay themselves a salary, they get distributions, how does the lender or underwriter kind of maneuver those 3 different streams of income to say, okay, well, we got this much from this much from this much from this? Or do they look at them individually? Do they look at them collectively with individual numbers? Like, how does that play on the underwriting side?
So that's a great question. A very good question, because people try to manipulate the system with this and you can't once they see the whole picture. So if you're having distributions, they want to know what we spoke about earlier. okay, is this distribution something that's consistent? Have we been seeing this over the past 2, 3 years or so?
Mhm.
Or is this something that just happened one time?
Right.
If it just happens one time, it's something that's not consistent, we can't use it. The underwriter is not going to use something that's not sustainable or happening because they're like, what's the long term of this loan? Because if they took 80,000, they're not going to take that 80,000 again or have taken it again, then we can't count that as income. And then what they do is start subtracting these things away. So it's all about what's sustainable, what's real or what's not real. And a lot of people get caught up because they're like, oh, we can just put this, but it's like, did you really take that distribution and where
Or
is
are
it
you
coming
just
from?
saying it just for purposes of buying a
Exactly.
house?
We need paper trail of everything you do so we can make sure we can count that income that we're adding to your total overall sheet.
So what it seems like is that the more information they give you up front, the better you can navigate how to get them into not only the best program, but the right program for them. Because
Correct.
self-employed borrowers, there's tons of different types of loans that they can have.
Correct.
But if you don't give me the whole picture, how can you put them in the right situation? Kind of like being a doctor.
Correct.
If I go to the doctor and say, doctor, my knee hurts, but really it's my head that's pounding, he gonna prescribe me something for my knee.
Exactly.
And I could have something seriously wrong with my head and he not know, but because I didn't give him the right information. I guess if you put bad information in, you're gonna get bad information out.
Exactly.
Okay.
And that's and another point to that is cool because what we're talking about right now is self-employed borrowers who are looking to do traditional financing, get the lowest down payment, possible down payment assistance. But this is just like you just said, this is just one piece of the puzzle that they can go and have less headache and less stress also.
So what other types of loans are available for self-employed borrowers?
So we have bank statement loans. My favorite, we have DSCR loans.
What DSCR stands for?
Debt service coverage ratio.
And debt service, for people that don't know.
And only thing that means is what's your mortgage payment compared to the rents you can actually receive for that property. As long as they can be close or matched together, some can actually be negative and you can still get the property. You just have to pay a larger down payment. But that's all that means. Debt service coverage ratio is what that mortgage payment is based on what that rental income coming in closer together, the better.
So you're getting approved not based on you as the buyer, you're getting approved based on can that property's rental market sustain the mortgage payment?
Yep, it's the performance of that property right there. So it's a couple of ways you can dig into that too. So when you have a property and if there's already a tenant in there, you can, that tenant, depending on how much they're paying, when their lease is up, you go based off of that. If it's a vacant property, you can get the market rent from the actual appraiser. They'll give you market rent, what you could do, and then that's going to be the estimate that we give basically to cover the DSCR. If you put, you can actually find a tenant, get a lease, put the tenant in it for whatever your actual rent is going to be, not the new rent, and now you can use that new rent before you close on the property. Yeah.
That's interesting.
Yeah.
But you would have to work with the seller on that because that's the seller would have to put the tenant in, correct?
Correct. You put the tenant in, you'll collect first, second, last, depending on whatever the deposits that the lender require, and you got to show it actually hitting an account. So you got to show the money actually going in, and then now they're under a lease, you can put the tenant in to the property, and now you can use that new rental income to qualify.
I didn't know that.
Which can save you 5% or more on putting it down, on down payment also.
Okay. What's the difference between the investors, Freddie Mac, Fannie Mae, when it comes to self-employed borrowers? Is there a difference on what they look at, what their guidelines are? Is that something the homeowner should be concerned about? To talk to you, say, hey, I want a Fannie Mae backed loan, or I want a Freddie Mac base loan or back loan. Or is it something that on your side, you know the difference, you look at their picture and say, okay, well, this one isn't going to work for them, I'll go this route?
So the way I look at it, and I think the way most loan officers look at it on our side is like, Fannie is risky, Freddie is more flexible. So we go to Fannie and say we have a self-employed borrower and they have declining income. Fannie is going to be tough on that declining income. You better be spot on. You better have your letter of explanations ready and it better make sense. You go to and that's DU. You go to LPA with Freddie. Freddie is flexible. They're like, okay, explain to us why this happened. Show us a trend. Give us a CPA letter. Give us all these other documents, supporting documents to make it make sense. So when we speak to borrowers and we are deciding on where to place the loan, it's like, okay, let's place it both places. Let's run DU and LPA, and let's see if we can get the approval and which approval is lighter and easier for us to maneuver. And usually, the more flexible one is going to be Freddie.
Okay. Is there a minimum number of years a self-employed borrower has to have owning a business or in that genre of business or in that space in order to qualify?
2 most of the time, but you can get away with 1 year, 1 year of employment. A lot of that, from what we see actually now, is what line of work were you in prior to also.
Okay.
So if you were in the same line prior, you can get away with that sometime. And how strong have that year been? But that's very rare that you see a company able to have 1 year sustainability to get approved. But usually it's 2 years. You can go from W-2. You can go from 1099 self-employed to W-2 to calculate your income right now. But if you go from W-2 to self-employed, you have to wait 2 years.
2 years. Okay, so you go from the business to W-2,
W-2,
you're fine.
You're fine.
As long as it's in the same industry?
No, it don't have to be.
Does it have to be the same
You just got a
industry?
stable income now. It's W-2
But if you go from W-2
to
to
1099.
1099 or to a business owner, then you need to
You wanna
wait
clock
at
down.
least 1 year.
1 year sometime, depending on the
situation.
situation. Yeah, but it's
But 2 years is the safe bet,
correct.
regardless of what your situation is. At 2 years, obviously you have to qualify,
Of course.
but at 2 years, that's the basically the standard for a
Yep.
self-employed borrower.
So when I spoke to we speak to the underwriters a lot on the broker side, contrary to what people actually believe. So when we speak to the underwriter, the biggest thing the underwriter say, Jay, if they're coming from working at a construction company to as a manager, whatever, to owning a construction company, and their profits are strong, that makes sense to us. But if they're in a whole new line of business, they never done it before, then we need to show, and it's not strong, we need to show another year of profitability.
Are there compensating factors where they can say, all right, well, he doesn't have the history or he doesn't have the business profitability, but maybe he has $1 million in the bank, or like, are there something, or maybe his credit's 870, even though I think it stops at 850. Are there compensating factors that can help you get around some of those time crunches?
No, because it's not income. And we get caught up in that a lot with a lot of people who have money but don't have the income no more.
Right.
They go, I have $1 million, but what income is coming in after that? Because that $1 million eventually is going to leave if you don't add income.
Correct. Okay. So client comes to you, says, I'm self-employed, ready to get a loan. What documents can they expect to provide you to get approved?
So it's 2 things. So if they're coming to me for traditional financing, we're going to ask for, and that's trying to use their W-2s, their tax returns and pay stubs, and if they're W-2. So we're going to ask for last 2 years of last 2 months of bank statements, the last 2 years of personal and business tax returns, K-1 if applicable. Sometime they ask for a balance sheet, and then we're going to be asking for actual year-to-date. Year-to-date income, and then it's going to be a CPA letter to verify, okay, the year-to-date. I do that up front. You might not need a CPA up front most of the time, but we try to do as much stuff up front because the easier you present it to the underwriter, the more comfortable they're going to feel.
They have to ask questions. They're like, well, why was he hiding this? Like, it's something he didn't want to tell me. But if you give the whole picture up front, they can make the best informed decision the first shot.
And that's the missing piece to this whole qualifying for a mortgage, especially for self-employed. We've lost connection with our partners and our realtor partners and our borrowers because they don't want to, you're asking for too much. Yeah, we don't want the underwriter to ask us for this stuff if we haven't. Let's review it, paint the picture for them, submit the loan, and we're good to go, because they're going to see confident, they're going to feel comfortable, we have everything, and you're organized, so they can believe the numbers. The other two is, if you're going to do bank statements, we can do 12 to 24 months of bank statements, qualifying on the income coming in. We can do personal or business, or some lenders actually let you combine personal and business. And then the last one is DSCR.
Okay. What are some common red flags that you see when you're getting this documentation that be like, I don't know if this deal is going to fly, or maybe this person isn't being completely honest.
So for me, is if they don't have a document on them. So if somebody say, I don't have my tax returns, that's a red flag to me. Like, what do you mean you don't have tax? Everybody gets their tax returns back through PDF.
Right.
Okay. Call your accountant or CPA, whoever, and ask them to send it to you, or put us together so we can contact them and get the documents.
Right.
And that's taken forever to actually get.
Happen. Right.
And that's a huge red flag. So I'm like, if you're a business owner, you should be a lot more organized on that part of that side of the business also, because you need this to, how are you going to get business loans? How are you running a business? Because that's the first thing the underwriter is going to ask. How are you running a business and you have no documents?
Right. Okay. Now, is it a red flag because the business might not be strong, or is it a red flag because they might be doing some shenanigans on the back end with their taxes and, what is it called when you file your taxes, amend your taxes. So a lot of people will, I'm gonna file like I made $500,000 and my tax liability is this, and then I get approved for the mortgage, and I go back and I amend the taxes to what I really made, so I don't have to pay those taxes.
Yeah, don't tell us that. Don't tell us that. If you need to do that, then you're not ready to buy a home. Or we can go another route. Let's go DSCR. Let's go bank statement. But there's no point of you know what I mean? There's no point of doing that, because one, you're going to put yourself at risk, and two, you're putting us at risk of doing a loan like that.
But it happens.
It happens a lot.
A lot, and there's people out there that create fake pay stubs and fake bank statements, and amend tax returns and stuff like that. And I don't envy you, because you have to almost be like an FBI agent, and there could be something where somebody sends you a fake bank statement or a fake pay stub and it looked legit.
We've had them.
And then now the lender comes back at you and is like, hey, I need to question everything that you do, because you send me these fake bank statements or fake pay stubs. And now that could affect your business with that lender going forward, because somebody tried to pull a fast one, when all they had to do was pick up the phone and say, hey, Jason, this is my situation. I want to buy a house. How can we make this work? And then you'll use your professional knowledge and your expertise and say, okay, well, you're not ready because of XYZ. But if you do ABC in a month, 2 months, 3 months, we can get you qualified without having to do all this fraudulent behavior.
Well, we caught it a few times, and it got past in the beginning because we're looking, everything legit, the numbers, like it's all there. Then I got an email one time, and I'm like, hold on. Why is this lady sending me an email from this weird address? It's not the business address no more. Mm-hmm. So we did some research, we did some calls, looked up the business. We're doing all this stuff that we usually do. And as we're digging, and we're like, hey, we're not going to even submit the loan. So I told my account executive, like, yo, we're not submitting this loan. This is fraud. We don't know if it's fraud, but it looks like fraud, and we don't feel comfortable with it. So we're not going to do it. Everybody got mad at us, like, because my processor was the one, once I told her, she looked into it even more, and then she was showing me stuff, and I'm like, we're not going to do this. And then come to find out, a couple months later, it was actually fraud, because they try to pull it with somebody else. And I'm like, if you know this is like, if you're a realtor, this is fraud, why would you pass that on to a lender?
Can I answer that question as a realtor? Mm-hmm. Because they only care about their commission, and they're not. If they know it's illegal, they can always say, plausible deniability. I didn't know it was illegal. Even if they know, it's kind of hard to prove intent and what somebody actually knew. Yep. But if I send you there and he closes your deal, I get paid. Versus, hey, you submitted fraudulent documents. I can't work with you. Now I just lost a client. I just lost $10,000, $15,000, $20,000 worth of commission. So they're not looking at the morally or the ethically, most agents, I'm not going to say all of them. Yeah. They're not looking at the morality and the ethical thing that's happening or the unethical thing that's happening. They're looking at their pockets. I want to get paid. I want to lose this. Now they might not. You work with that client in the future, but if that deal closes, they're gonna spend that money like it was a legit 850 credit score borrower, 20% down, like the most traditional borrower. They're gonna spend the money all the same. They
Yep.
don't care.
And it creates bad habits though for the industry. So now we're creating these. Okay, we got by. Let's keep. How far can we push this? And it's not fair because sometimes I mean majority of lenders don't want to deal with that because it's like, okay, we can get 10, 15,000, but why put my license at risk for 10, 15,000 if I'm making over 100,000 a year or more than that? Like it doesn't make sense. And for yourself also, like you don't know that borrower. That borrower going to throw you under
Throw
the
you
bus
under
as
the
soon as
bus.
they get caught.
Oh, they knew I was. Matter of fact, they sent me the software to create my pay stub.
Yep.
So they sent me to this person who helped me create the
Yep.
fake pay stub.
They told me to do it, and it's like, come on now. Why
Mhm.
would you put that on me? Especially if I don't even know you. Like and there's a couple of them we didn't even know the people. Somebody called and said, "Hey, you got a referral. We heard you could do the loans, and we're doing like this is easy." Then once it gets too easy like that, when it's passed on 2, 3 lenders, we're like, hold on,
Something's off.
something's off. Because I know these lenders are really good. How they didn't catch this?
So do you like to deal with referrals like that, people you don't know or don't have a relationship with, or do you like to deal with people that you know, trust, and you know the brand of work that they do is in alignment with the same type of work that you do?
I don't really care about the referral because now my process is different than it was several years ago. So we ask a lot more questions. We dig in. We do way more work up front. And my processing team, which I'm working with you guys now, which has been amazing. We're doing more due diligence, and on that due diligence, we're finding more things out about the borrower and the people up front, so we don't waste 30 days trying to figure out what's going on.
Okay. How far in advance? I'm a self-employed borrower. I want to buy a house. How far in advance should I start having these conversations, making plans, kind of formulating, my game plan to be able to buy a house when I'm ready to pull the trigger?
What I tell everyone, as soon as you think that you want to buy a house, you should start speaking to somebody. You don't need to probably get full pre-approval, which I always recommend. Stop doing it. I don't like doing estimates for people because the market now is different than the market 10, 15 years ago. It shifts way too frequently. So you do a pre-approval. It's going to drop my score. No, it's not. If your score is bad, you have bad score. If you got a good score, you got a good score. Like this dropping the score stuff is crazy to me.
So that's a myth because a lot of people say, "Oh, don't pull my credit." Well, how do you expect me to give you a pre-approval if I don't know what your credit score is?
Exactly.
And you could be 680, might get you a different rate than 685.
Yep.
700, 699 might get you a different rate than 701.
Yep.
But if I don't know that, I don't know that. A lot of people, oh, well, my Credit Karma says,
Yep.
or my Wells Fargo or Chase app says my credit score is this. Mortgage scores aren't the same.
Yeah.
They're different.
Yep.
So we need, if they were all the same, you'd be like, okay, cool, show me your Credit Karma. Okay, cool, I can get you approved. But because mortgage scores are differently calculated than the traditional credit score, you can't always rely on having that good credit, quote unquote, that they think.
Correct.
Because of what Credit Karma says.
And there's actually brackets. I don't know if we can put it up here somewhere. There's a bracket where it shows you where your scores goes from this, where the actual rate would actually change.
Okay.
And I can provide that to my clients. Like, look, if you have a 600, we need to get to a 620 or 590. We got to get over that threshold to get the better score. The thing about that is that it doesn't change it that much. And the reason I say this because most borrowers, when they buy a home or they get a rate or they get their monthly payment, they're thinking of 30 years. Most people don't keep their home for more than 5 to 7 years without switching the mortgage.
I don't know anybody in this generation that owns a house or has owned a house for 30 years.
No.
That's like your grandparents' stuff. They bought the house and they stayed until they died 50, 60 years later.
Exactly.
I don't know anybody.
Exactly.
I think we bought our first house in 2008, end of 2008, right before 2009. That was our first house we bought together. And since then, we've had 1, 2, 3, 4 houses in 18 years. So you're talking every 4, and
Yeah.
the shortest we've ever had was 18 months.
Wow.
And that was during COVID when we bought it for 645 and sold it for over 1.1 million.
Oh.
And that was just, it was too good.
Why won't you do that?
It was too good to pass up.
Yeah.
And we didn't even, it wasn't even the fact that we were in the market to sell or we said, hey, prices are going crazy. We literally had outgrown the space and wanted something a little bit
Wow.
different. And it just so happened that at that time, that's what the market was.
Yeah.
So it wasn't anything strategic. It just so happened.
That was during COVID?
That was during COVID.
That's the blip. So how much
That-
is the house worth now?
It's that. So that house was the first house in our neighborhood that sold in that square footage that sold for over $1 million.
Wow.
From that point, every single model of that house has sold over $1 million since we were the first ones to do it. So because of the neighborhood that we live in, the city that we live in, the values don't typically
They don't
change.
fluctuate
They
that
don't. They don't fluctuate negatively. I knew somebody that lived in the same city, not the same neighborhood, but he said during '08, that city was the only city in South Florida, or one of the few, that didn't lose value like everybody else. Because the school district is good, because
Wow.
everybody wants to be there, it didn't lose value like everybody else. So it just, that blip that you said was a good blip,
A perfect blip right there.
perfect blip.
But you and your wife are not emotional about real estate. Because an emotional person would have kept the home and say, this is my forever home, instead of taking the cash and being able to do more with that money.
The funny thing is, when we bought that house, she said, we're going to stay in here until our youngest son goes to college.
Mm-hmm.
At the time, he was, I think, he's 13 now. So this is about, COVID was 2019. So we're talking 7 years ago. So he was 6 or 7.
Wow.
Here we go again. And that would have been another, 11 years,
Yeah.
12 years. And 18 months later, we were out.
Yeah, that's amazing.
So it, like you said, it was that perfect blip, and we took advantage of it, and it helped propel us to where we are,
Of course.
where we are now. And did we buy that one? No, that one was a traditional loan that we bought it. But we looked at some creative financing because we're self-employed.
Yeah.
Bank statement programs we could have done. How do they work? Are they a good option? I know investors, especially nowadays, love DSCR.
Yep.
But are bank statements good? Are they still popular?
Yeah, bank statements are real popular because if you use bank statements, you can go down to 10% financing. And you don't have to put the 15 to 20% like the past or what some people say. You go down to 10% and they'll give you a nice amount of income also from those bank statements. You know, they want to see the income coming in. They want to see, they're assuming when you have your personal bank statements in your business that whatever expenses you had, by the time it got to your personal, it was been already paid
That's
off.
good. Yeah.
So now they're going to give you a little more income. So now you can use that income and actually qualify for more and be a lot more comfortable.
Okay. So we talked DSCR. We talked bank statements. Asset depletion. Tell us a little bit about those.
So asset depletion loan is real pretty simple, right? They have it's a calculation too and everything, but it's your assets you have and what you can actually make from them assets. As long as it's not something where you're capped, like sometimes 401ks, you get penalized or you can't take as much out or you don't have enough vested in that actual investment. But man, you can do a lot of products, investment, retirement accounts, checking savings, IRAs. Depending on how much assets you have, you can actually use that and transform that into income and use it to qualify for a home also.
So they basically base it on like the distributions that you get from those
Correct.
assets
Correct.
as income.
Correct. And they actually have another calculation where when you're using that when you're using that asset depletion, and let's just say you have $3 million in the bank, they can actually say, okay, they have $3 million in the bank, and then they'll do a calculation to see how much it'll be just to make sure you can sustain that mortgage for 30 years too. So it's great for those programs for people. I tell you, like, there's wealthy people out there and they get pre-qualified and people take them to the ringer. And it's like, bro, just find a program that fits them. Because if I take a wealthy person and they're willing to put 15 to 20% down, why am I trying to get them why am I trying to get them these loans that are difficult when
Right.
their money is not being shown the way it's supposed to be for traditional financing? Just put them in another program, which is easier, and they can use their assets or whatever their ability to finance is, and just use that program.
I'm going to ask you a question based off that statement.
Mhm.
Do you get paid as a lender differently regardless of the program that you put them in?
No. So
Because that might be why they're forcing the square peg into the round hole if they're going to get, a higher commission out of it versus saying, you know what, I'm going to put you in something that fits you,
yeah.
but it's going to pay me less.
No. So if you're a broker, it's a little different because we can get borrower paid or lender paid. Usually those type of loans is probably gonna be borrower paid. So you'll figure out what the commission is if you're comfortable with the pay. If you're with a lender, I mean a direct lender, it might be a little different how you get paid on those deals. But for the most part, you're gonna probably get paid about the same on most of those deals. It's just when you're dealing with that, it's probably gonna be a little higher depending on the loan amount, but it's the same.
Okay. So it doesn't play a factor.
And you should not be putting people in programs if it doesn't pay you enough money, because that actually happens.
What do you mean?
They want to put you in a program that's more beneficial to them as the professional instead of what's best for the borrower.
Oh, I mean, that happens
Yeah.
in real estate and mortgages.
Yeah.
I'm sure it happens in title as well. And this is why the NAR lawsuit came about and why
Yeah.
all of these things happen is because as the professional, people come to us to guide them
Yeah.
in their best interest. And a lot of times they're guiding with their pockets as the main factor and not what your client wants or what's best for them. I've had agents tell me, well, I'm not going to, on a listing I'm not going to show your house unless the seller's paying me 3%.
That's crazy.
Well, are you buying the house or is your client buying the house? Because if your client is interested in the house, regardless of what you make for commission, you're supposed to show that house. And it's wild to me that you actually come out your mouth and
Yeah.
say these things
Yeah.
because this is the reason that we're in the situation that we're in now is because of
That's correct.
agents like you.
That's correct.
I'm not showing my buyer the house for 1% commission. I don't wake up for 1%. Well, 1% is more than you made today.
I get it. You want to make more money, but I don't get it because now you're putting the borrower at risk that has nothing to do with how much money you're making.
Correct.
So you're like, I'm not going to show the house because it's not paying me enough, but that's the perfect house for your borrower. Like, so now you're going to keep
Perfect
the borrower.
location, perfect payment, perfect everything, except for what goes into your pocket. And you don't want to show them that because you're not going to make enough money.
So the borrower's in the market another 4 months, then get buyer fatigue and then decides not to buy. A month later, they find somebody else and buy a home with them right away who don't care about the commission. They just want to get the borrower in the home. It's like writing a book. Like we see this all the time, man.
It's sad to be perfectly honest. It's really sad. Like I've sold houses and not made any commission because it was the right thing to do or it was a friend. Not saying I want to work for free, but if this is what it takes, I'll give you a perfect example. I had a friend of mine, he's bought and sold a few different houses. And him and his wife were getting divorced and they had just bought a house recently in a neighborhood and a house came up for sale that was, I don't know, maybe 10 or 15 houses away around the street, around the corner.
Mm-hmm.
And we went to see the house, beautiful house, fully remodeled and multiple offers on the house.
Wow.
I talked to the agent, whatever. And I said, listen, what's it going to take to get the deal done? And he's like, we got a lot of offers, some over asking, this, that, the third. He's like, listen, I don't want to pay over asking. So I said, okay, how can we get the deal done? And the agent, and I don't know how unethical it is, but he was like, well, if you let me represent your buyer, I'll make sure he gets the deal. Now, I could have been like, hey, I'm not going to give my client to somebody else. I want the money. Or I could have said, hey, this is what's best for my client. He really wants this house. It's close to his son. Like his son could literally walk between the two houses. Okay, go ahead. I've done business with him before.
Yeah.
When matter of fact, he just texted me a couple days ago, hey, how much is my house worth? I'm thinking about selling it. But do you think he would have called me that if I had been concerned about my commission when
Exactly.
he bought the house?
Exactly.
No, you do right by people, right will come back to you. So sorry for getting off on that.
No,
that little tangent,
that's
but
a good example of why we do this business. And no, we don't agree with the NAR, but we understand it. And that's
Mhm.
what I tell people. I don't agree with a lot of stuff in the industry that changes the rules. Listen, I got it in 2005. Didn't nobody have it harder than us when they revamped the whole industry?
'cause
When they
if you
told
had a
us,
heartbeat, you got a house. You were
yes,
approved, stated income.
yes,
Hey, I make $10 million a year. I want to buy this $8 million house. Okay, here you go. Here's the keys. I know people who literally said
yeah,
they made millions of dollars and bought multi-million dollar houses
yes,
based on what they said.
yes,
But that's what it was back then.
yep.
It's not the same anymore.
No,
So we have to evolve,
it's
but
true.
we still have to learn and be professional and do things the right way so the industry can last.
Yes, we don't want the Wild Wild West again. It's not good for us getting people who are not qualified in this business. And people don't understand, like, oh, I want the rates to go down. I want the law to change. I'm like, yeah, but you're creating a Wild Wild West.
Mhm.
You're creating people, I call them COVID babies. They came in during COVID and then they stayed a year or two and then they left because they were just chasing the money. They didn't care about the customer. You know how many customers got into bad deals and bad homes and things like that?
Mhm.
And it's like, yeah, you make mistakes, this happen, but some of the stuff was intentional.
You intentionally put me in a bad situation.
Yeah.
Okay. When a client, self-employed borrower, let's say my wife and I are both self-employed. So say she wasn't self-employed and she had a W-2 job.
Mhm.
Does that affect a loan approval? Does that affect, are you looking at her as a detriment to my business, an asset because she has stable income? Are they two completely separate things that you add later at the end? How does it work when you have two borrowers on the loan that have different sources or structures of income?
I love it because now it creates more stable income. And then we don't got to go through the hassle of people talking about amending and doing all these other things with their tax, especially if it's a high earner. So if they're a high income earner, W-2 earner, that makes it a lot better. So we can just take whatever the tax returns say, take that taxable income, whatever we can add back. If we can't, we have that other high stable income, and then we can just go move forward that way. And which is funny because I have a couple of those that I've done over the past couple months.
Nice. All right, so we're coming down to the end of the episode. I got a couple more important questions I think the viewers, need some clarity on or could learn. What is the most expensive mistake a self-employed borrower can make prior to getting approved for a loan?
So personally, I think the most expensive mistake they make is not claiming enough taxes.
Mm.
Because the thing I don't think the concept, which I don't think a lot of people truly understand, is if I'm paying more taxes, I'm showing more income, I can buy more assets to make up for that lost income or that
The loss of the tax liability.
Yeah, the tax liability. So if they just do a mindset shift and stop seeing it as a negative and see it more as a positive to do more with it, I think that's where they lose most of their money because people are like, they're literally repeating the cycle over and over again. I'm gonna pay a little amount of taxes, and every year it's like, come on, like think about the positive on this and the benefits from paying your taxes, having more purchasing power now, less risk to the bank, less money out your pocket, putting large deposits down, 15, 20% when you can do 10%, 15%,
Okay. How important is it for a self-employed borrower to find a self-employed lender or a lender that specializes in self-employed borrowers versus going to, no shot, but a Bank of America or Wells Fargo, or like these traditional cut and dry big box banks?
I think it's very important. I think I'm always sticking for brokers because we're not cookie cutters. We don't have a cookie cutter box, which you go to Bank of America, you go to Chase, you go to all these other banks. It's like, okay, you don't fit in this
In my
round
Bank of
hole.
America box.
Yeah, you don't, you're denied and you get discouraged. If you go to a broker, I mean, at Nexa, we have over 300 lenders that we work with. So we can shop your loan around to 4 or 5 different lenders and see who gives us the best, less amount of stress, best rate,
Best
who can
terms.
structure it, best terms. And if we do it that way, it gives you the least amount of stress on yourself, having to worry about if this lender says no, I got to get my credit re-pulled all over again. I got to find a whole new lender to speak with, a whole new loan officer. It streamlines the process when you're working with us. So I say go to a broker, preferably applywithmrbenton.com.
Shameless plug, not so shameless. Applywithmrbenton.com. All right, so let's get into a couple like true and false questions. Self-employed borrowers always pay higher interest rate than W-2 employees.
That's false.
False. Okay. Someone's been self-employed for 18 months and really wants to buy right now. Do they have an option? Should they wait?
They definitely have an option.
Okay. And final question: what's the one piece of advice you wish every self-employed borrower knew before they got into their current situation or coming into a situation where they're going to speak to you or go to your website to apply?
The most urgent thing is to let your tax professionals know that you plan on buying now or in the future. Get with a loan officer, applywithmrbenton.com, and let's work together with your tax professional to make sure you're structuring and you're claiming enough income to qualify for what you're looking to purchase.
All right. So if you had to summarize this whole episode into one key piece of advice, what would that one piece of advice be?
Plan. Get your team together. You should have a team. You should have a realtor. You should have a loan officer. You should have a tax professional. And you should plan how you're structuring your business, plan how much money you're making, plan your purchasing power. If you plan on being a home buyer or an investor, you should plan. I think that's the most important part.
I didn't intend to end with this, but you said something, and I'm going to ask your opinion. You said you should have a team, and you mentioned realtor and loan officer, title, CPA, the whole nine. Do you recommend having a team of professionals that are an actual team, or do you recommend saying, oh, my friend is an agent and my cousin is a loan officer and, my church member works at a title company and none of them know each other? Is it better to have somebody like a team that has worked with each other or that knows the business to get you to the end goal, or it doesn't matter? You can pick from all different places.
I think there's pros and cons of both. People who know each other might be all in together to try to pick you apart to get as much money as possible. The people who don't know each other might not be able to communicate the best way possible for you, or you have 4 or 5 independent people who you trust, who you know is going to have your best interests at heart.
Okay. But even if you trust them, they need to have the experience and expertise in what it is that you need.
Exactly. Listen, I don't recommend using new people when it all depends on the type of borrower. Because when I get a referral and I have, let's just say I have a jumbo loan, $1 million plus, and I know the borrower, I'm not going to give them a new realtor, because they're going to be like, no, I need somebody experienced who've done this before. So I think that's the most important part. I don't like to say don't use new people, because we all have to start somewhere, but have a conversation to make sure people are competent in what they're doing.
Yeah, because there's new people that are competent and new people that aren't competent.
It's amazing new people out there, and realtors and loan officers, title, they're great.
Okay, awesome. So tell people how they can get in touch with you, all of your social media details, so when they're ready to make that move, they know who to call.
So you can reach me at all platforms. There's 2 ways: Apply with Mr. Benton or Jason Benton. You can reach me at applywithmrbenton.com. I reply to emails. My email is jbenton@nexalending.com. You can reach me there. And also you can reach me on my podcast for financial literacy on Secure the Bag podcast. That's on YouTube, Instagram, and Facebook. And you can reach me there, and you can reach me at 305-528-5049. Whatever you need, I have a huge network of people who can help you, and we'll make sure that we'll take care of you.
Awesome. Guys, that wraps up another episode of the Free and Clear Real Estate Podcast, where we talk all things real estate and we cut through the noise. I know I switched it up, but just trying to do a little something different today. See you guys next week on another episode.